Someone with Taijan called.
Huh? See, you don't get there, but it's in place and it's a bit sometimes boring once later.
Start looking again. Get my notebook.
Okay. Who is a economist at the growth team of the Research and Development World Bank Group. And right now he's on leave and he's at ESSEC School of Business, and basically he specializes in public policy, and he also works at the European Union Tax Observatory. He's an expert on taxation. So we have the honor to have it here, and as usual, we have 1 hour. You can take questions whenever you want.
Go ahead with questions.
Perfect, and the floor is yours. Thank you very much.
Thanks for inviting me. I'm very happy to be here and to meet the colleagues here. I'm on leave from the research group at the World Bank. So this is very much work that had started while I was at the World Bank, and we like to continue when I return. So today I'll tell you about the effective tax rates firm size, and with the focus on the global minimum tax that's been quite a bit in the news. Why care about this topic? So first, the corporate income tax remains an important source of government revenue. Maybe a bit of data on this. Here in these two graphs, here you have the GDP per capita of a country. So each dot is a country, and that's the share of the GDP that they collect in corporate income tax. So you can see on average it's maybe 2.53% roughly GDP collected from corporate income tax. This looks relatively flat, right, with income. But that's because poorer countries also collect less tax revenue as a share of their GDP. So if you now move the share of tax revenue to the right, you can see that the corporate income tax is still a more important source of revenue for low and middle income countries. Okay, so about maybe 20% of revenue on average collected from corporate taxes. So, despite all we've heard about, the corporate tax remains kind of an important revenue raising instrument. In the same time, it's true that we've had this movement towards less tax being paid by corporations, and especially by the larger firms, right? Actually, we're talking with Agustin earlier today. This is a trend that very much has happened in Malaysia. And, I think something interesting is this has happened for a variety of reasons. One is this kind of tax avoidance by firms, via profit shifting, especially for digital firms. It's become easier to kind of move your profit across jurisdiction. The other one is a true tax competition between governments to attract firms. Sometimes we have statutory tax rates that have been falling, but even more often via tax incentives, right? So those can take tax credits, income exemption, reduced rates, right? There's a whole range you can offer to try to attract firms. Today, it's going to be a very mechanical talk and focused on the fiscal cost, right? So we're not going to think a lot about the behavior of firms, and we're not going to enter into the very hard topic of, are those incentives warranted, that they generate enough spillover and so on. And, the answer to that, it probably depends which one, right? So this is an ambiguous and complex kind of welfare effect. We want to focus on the fiscal cost and specifically how it relates to the minimum taxation changes that are going to happen. Yeah.
And then, and are you going to talk about this only from the perspective of tax incentives and breaks? Because like you already highlighted, that even if, say, I was to stop giving these breaks, right? But then the firm's behavior might in fact shift more in the line of following more practices that minimize my tax bill, whether through avoidance, profit shifting, whatever practices they might follow. So how should I think about this fiscal cost? Potentially a fiscal cost that's going to be borne by the government, or
So it's a good question. So everything I'll show you now is about how, how actually little firms are paying. And I'm only showing you one dimension, which is the dimension via tax incentives. That means that tax evasion or tax avoidance is not in the picture.
Okay.
How will that evolve over time? So, the minimum tax, and I'll tell you a lot more about it discussed at the OECD, its first objective is to curb tax avoidance, right? So that's hard to think that would increase, and, we can discuss. What you're right is other behavioral responses could be like pure tax evasion or other things. That's possible. We're going to be talking a lot about very large firms, for which I think, this kind of basic underreporting of sales, for example, is not really something accessible, right? Now, what you're right is I'm sure as you close some things, other loophole could arise in other ways, right? And so that's going to, that's what I meant by very mechanical. There's not going to be a lot of behavioral effects. We can talk about that a bit later. I think one of the reasons is just there's enough changes right now that just even thinking what's going to happen, what are going to be the pure mechanical effect of this, I think is worth thinking. And then we can think of the quite hard game that's going to happen, because I think some countries will implement the minimum tax, others won't, And so what's going to happen in this world, I don't know. That's probably the next paper. We're going to ask 3 questions, right? The first one is simple. To what extent do tax incentives lower effective tax rates? And then maybe even more interestingly, how do these effective tax rates vary with firm size? And I'm going to show you actually quite systematic relationship between firm size and effective tax rate that I don't think had been documented before. And the third one is, with this mechanical calculation, how much revenue could a minimum tax rate raise potentially? Okay, so those are the 3 we're going after. I'm sorry, I don't know why it shows up a bit funny here, right?
Is it on full screen? Maybe that's why it's not. Maybe you should again go to slideshow and then maybe.
There you go.
Yeah.
That's better, right? Okay, very good. So I think what's really cool in this data, and I really want to highlight, that's one of the advantages of working with the World Bank. A lot of my work is much more micro and using this type of corporate income tax administrative data set. And so here, with my colleague and Brockmeyer, who's also at the bank, we've kind of combined our work in about 14 countries. I think today, this keeps growing as we get in demand from more countries. These are the full population corporate income tax data. So what is there is literally all the formal firms in the economy, or those that are large enough that they're supposed to fall under the corporate income tax. So who's not there? Informal firms, and firms that are small enough that they might fall under the presumptive tax regime, the self-employed tax regime, or those other type of simplified regimes. Okay. And the reason why we're not including those is even though those firms are filing something, often you cannot measure profit accurately, right? They might just report assets or total sales or something like that. Okay. So it means, the structure of these data sets is actually going to be quite comparable. The type of firms that are in might vary from one country to the other. In Africa, it's really going to be the top probably few percent of firms. As we go to relatively richer countries, we have Greece in the data, for example. We're going to get France, you get a much larger share of the economy. Even then, I want you to think that, because we always have the largest firm in the economy, in terms of total value added of the economy, we're going to capture a large share, and that's true in every country. Okay. And so we're going to develop this effective tax rate measure that, we're going to try to make them as comparable as possible based on the tax return. And then we're going to look at the pattern with relation to firm size. For firm size, our main definition is just going to be total sales. And that's because that's the one measure we can always observe. In some countries, I can show you what it means if you look at total number of employees and total assets. It actually looks very similar. So we don't think that's a big deal, this assumption. And so what we're going to find is this bell-shaped pattern, meaning the smaller firms are typically paying lower effective tax rate than the mid-sized firms. You get a peak in taxation for the, I would say, upper middle firms, right? Which you can think probably of them, kind of the 90th percentile. So those are likely to be relatively large domestic firms, I would say. And then as you go to the top, you get a pretty big dip in the effective tax rate of the very large ones. So, top 1% firm, if you compare it to a top 10% firm, based on average, I think it's now with the updated data, it's around 2.8 percentage points lower effective tax rate. Okay, and I'll discuss a little bit the reason. But then I want to be sure that, we get into, I think, what's particularly interesting this day, what's the fiscal cost? About 1% of GDP on average. But what does that mean under a world where you have a minimum tax? And so here I'll show you 2 things. First, you could imagine just a very broad minimum tax that every country would apply to domestic firms as well as to subsidiaries or multinationals. And this actually collects quite a lot of revenue, right? Around 25, 27% increase in the corporate income tax if you were to apply such a broad minimum tax. The one that is suggested right now and has started being implemented by countries since this January the pillar 2 of the OECD, in the few countries where we've done very detailed exercise, we'd only raised about a third of this gain, right?
And what's the difference between 2 and 3 in terms of structure of the tax?
So this would literally be every firm, I think in the simulation we've done now, is every firm in the 1% of size has to pay 15% effective tax rate.
Okay.
The one proposed by the OECD, you're going to see has quite a few loopholes
Okay.
and exemptions that come with it. And it only applies to subsidiaries of multinationals.
Okay.
Right?
Doesn't-
All domestic firms will not be part of that list. Okay. And so, that I will get into a lot of detail. So I think it's quite interesting what they're planning. Okay. Great. Let me skip this so we have time to go through everything. So the data I told you, the type of data is the corporate tax return. You can see here the countries in the data. I was saying that to Christine, unfortunately, we have no country from Asia, and that's one limitation, I think, for your interest also. And, I think one of the reasons is typically Asian countries have been a bit less transparent and a bit less willing to share that type of data. And I think that reflects. The other part is a little bit, I think, where I've worked. I worked a lot in Latin America and in Africa. So that's the idea. Something really important about this sample. These are all relatively high tax countries, high statutory tax rate countries. That means if you think of the debate of the OECD, a lot of these rules are meant to curb tax havens use, right? The type of countries that are having taxes that can be 0%, 5%, or something like that, right? This is being driven by the high tax countries, that were for a long time was the US that had one of the larger corporate income tax rate, but also France and Germany. So that's very much how the debate of the OECD has gone. The very large high tax countries and relatively rich countries have been driving the idea of kind of curbing the type of 0, 5% tax brackets of the taxation. The vast majority of countries in the world are this kind of in-between group. They're not the rich OECD countries, but neither they're the tax havens, right? They have statutory tax rate that might be 20, 25% or so, okay? And I want you to think of this sample as this type of countries that are often a bit absent of the debate and haven't had a lot of voice into deciding what's happening. So this is, you can see here a little bit more about the data. I think we haven't updated it with all countries. You can see that, there's a fair bit of dispersion in terms of GDP per capita. So we have countries like Ethiopia in the sample or Rwanda. At the higher end, there's Costa Rica, for example. I haven't updated with Greece, which would, I think, be the max. What I was telling you is the statutory tax rate. You can see they're always relatively high, right? The lowest is 15%, like in Albania, but most countries actually, the model number is 30 here, right? So these are a lot of countries that, at least on paper, are saying we taxing firms at quite a high. Okay. Now you can immediately see, if you look at the average tax rate across all firms and compare it to the statutory tax rate, you can see that there's a big gap, typically, right? It's going to depend a little bit on the country, but you often have at least 30, if not 50% gap between the two. Yeah.
What's like a typical global minimum tax?
So the one with the OECD would be 15%. So they had started actually at 21% and then they lowered it to 15%.
So if, let's say, global minimum tax is implemented, it wouldn't make a difference in these countries because they already have a pretty high statutory tax rate.
No, but the minimum tax is on the effective rate.
Right.
On the effective rate. And that's important. The one being discussed. So that's at least a thing that they've thought about, right? Yeah.
What is peculiar about Senegal here? Why is their ETR, average ETR close to max statutory?
Yes. In
Even under us.
Yeah, it's a good point.
Minus 25, 22.
Yeah, good point. Maybe we can look again at the figure. I forget how Senegal looks.
That's maximum rate, so it's upper bound.
Yeah.
But then, for many other countries, it's like the effective is almost half. Like, what are these outliers doing differently?
Yeah. It's a good question, because I don't have a good answer now. Let me think about it.
No, yeah.
This is not fascinating. So, the good thing is tax returns, they don't always look the same, but typically you can always reconstruct the same concept, by the way you're moving variables. And so I prefer to show you something like this. So this is Rwanda's corporate income tax return. What we always going to do is try to first measure the net profits, right? So that's going to be the total income of the firm, total revenue, minus all the expenses, right? And in the expenses, we want to count what we're going to call standard economic expenses. That's going to have labor, capital cost, materials, and so on, right? And so the parts we don't want to consider standard expenses are the type of depreciation or deduction that can be allowed, such as investment expenses, extraordinary expenses, and other things that. No, sorry, actually, I'm not saying the right though. Investment allowances, exactly. So the type of expenses, that are non-standard and that are here and allowed, for tax incentive reasons. So that's one possibility. The other place where you see a lot of tax incentives being given is via tax credits, right? So now you've already calculated the net profit and the tax the firm has to pay, but they get to deduct from the tax liability a whole set of things. So you can see we pick Rwanda because Rwanda actually is well detailed. So you can see why are they giving tax discounts? Well, there's some from free trade zones. That's quite a common feature. There's some from exporting firms. There's some from employment, right? If you suddenly get a lot of new workers in your firm, you get a discount. That's another relatively common one for newly listed firms, right? So that's an encouragement to join the capital markets and so on. The issue with this data is Rwanda is actually a pretty good case where you can kind of track the reasons. In many other countries, you have one line, or you have something that says, law 2053, right? And then if you go and read the law, there's like 15 reasons being given for why they're giving those tax incentives, okay? So think of the tracking of exactly the reasoning is actually quite hard from the tax data, and you probably need additional data to try to make sense of this, okay? So the measure of the effective tax rate we're going to use is the corporate income tax liability before all those tax credits, right? On this measure of net profit, which we take to be total revenue minus what we're going to call standard deductible costs. I want to highlight something, there's other measures you could do it. For example, one thing that really we're not accounted for is that I run standard depreciation, but right now we're just taking the depreciation number. Some countries give very big tax incentives, they accelerate the depreciation, for example, right? Meaning that the asset you buy now, you can already discount it at a much higher rate than it's true economically. Why we're not doing that? Because that would be really hard to do across countries, again, and it's not typically detailed.
At some level, you could be underestimating your effective tax rate.
We probably are. So we've taken every decision that everything you see, I think, is a lower bound on the true effective tax.
Okay.
And if you go back to the previous slide, here we are talking about all these deductions, right? Like tax credits that they kick in. So even if we forget about foreign placement decisions, which countries they go to depending on the tax rate. Like when we think of fiscal cost, it's like a partial analysis, right? Or it could be an upper bound on the fiscal cost because there might be fiscal benefits deriving from higher employment or whatever it is. Employment might also be in notches that if you're over 50, you get a discount, below 50. So firms might be, playing with those variables to get those credits, right? So how should we think of this fiscal cost? It's a partial equilibrium.
So it's kind of the spillovers that they might be generating, you're thinking?
Spillovers or even just within here, like we need to know exactly what discounts they're getting from employment.
Yes, I see what you're saying. You're right. And I agree. I think of it as within the corporate income tax, right? I think that works, but you're right that they could be spillover on other fiscal bases, right? And I agreed with that. And I think, for example, that's an interesting one, tax discount on listed firms. You could imagine that once a firm is listed, it's also much more transparent, its reporting improves a lot, and that has other benefits on less tax evasion, for example. Yeah, totally agree, right? So we can't really look at that. So it is partially agreed with that. Okay, and so as I told you, firm size is going to be a reported total revenue just because that's the one that we have systematically. Okay. So what does data look like? So in every country, we're going to rank firms within their country in percentiles, basically, of the total revenue. And here, you see the gray zone. This is a zoom in within the top 1%. You can really see what's happening to the very largest firm in each country, right? This right now has all firms, including the firms that are not making a profit or that are loss making, for which, a bit artificially, we think their effective tax rate is 0. Okay, they're not paying any tax. It's a bit wrong though. Now you can start to see the standard pattern, right? Which is typically, the effective tax rate will rise. Note also that this horizontal line is the statutory tax rate. So you now start seeing that there's a big gap, right? And in most countries, once you look at the gray area, you will see a dip. Okay? Now, we really want to be doing this for profitable firms, right? So we're going to quickly move to this. This is the share of unprofitable firms with respect to size, right? So you can see, especially at the very bottom of the distribution, you have a lot of unprofitable firms, right? Because you go towards the top, this tends to drop to around 20%. So now let's redo our measure, but only looking at profitable firms. This has eaten some of the gap, right, with the statutory tax rate now, but you can still see that in a lot of countries, you tend to have a rising pattern with firm size. And then, even more common is a dip, right, at the top. So Greece, Costa Rica, very big one, Mexico, and so on. France, we haven't redone yet the data because I'm pending access, but some researchers had tried to do something similar for France. And so France is interesting because a lot of people think of France as a very high tax country, and it is for some things. For the corporate tax, they've given so many regimes now for R&D and so on that, for large firms in France, this really looks like a very low tax country, right? So kind of interesting again, I think this kind of de jure versus de facto is something very different than
and in terms of share, so if I was to think about top 10% of the firms, what share of sales do they account for? Do they very, very
about 90%, I would say. These are very concentrated distribution.
Yeah, so about
when you get to the top 1%, you still typically have about a half, right?
Wow. Okay, so top biggest 1% of the firms are accounting for 50% of the sales.
Exactly.
Wow, that is okay. So they really care about the actual tail. Yeah.
That's right, 27% of the revenue.
Yeah.
Exactly. Okay, so let me, that's just like looking at all the measures of size. Let me show you this, which I think is kind of interesting. So one way, I'm not going to show you 15 graph every time. So we could do a cross-country average effective tax rate based on the last graph I showed you. It's hard to interpret, but at least it allows us to do some kind of interesting robustness. The first one I like is, this measure was done over 1 year. You could just construct the same effective tax rate over a larger period, and then we'll eat some of the losses and so on, and you're going to have more firms. So I think it's kind of an interesting measure. You can see that really nothing changes, right? So you can even do the 5-year measure, you get something very similar. The second thing that's interesting is, you can always at least get the major sectors. So what I call primary is agriculture, secondary is industry and construction, retail and services. Relatively similar shapes everywhere. Agriculture looks a little bit strange. Otherwise, it's quite similar with a particular big drop in the industrial sector. So maybe not a surprise there, right? But the red one is really the one dipping a lot. But you see that services are not that far, right? And so retail, less mobile potentially, not as big of a drop at the top. Okay, so let's focus specifically on the tax incentives for the top 1%, where I think, there's a lot of interest. So what we can do is just, let's look at the largest firm, the top 10% of firms, and then put a dummy for the top 1%, and then try to see as we control for more things, what can explain the drop in the top 1% effective tax rate. Okay? So we're going to slowly add, new controls or new explanatory factors. So this is the baseline, that gives you the average measure. So 2.7 percentage points lower effective tax rate for the top 1% versus the rest of the top 10%. If you just add firm characteristics, which in our case are two things, sectors and geography within the country, region, you see you explain already quite a bit. And I think that's something interesting, which is some of the variation, we can't just explain it actually with the line items on the tax return. But they could be geography specific, and that's probably capturing some of the special economic zones. I'm thinking, for example, right? We're not sure, but that's one of the big possibilities, right? Then lines.
And by geography, you mean like the state they're located in, or a latitude?
It's going to depend on the country, it's going to depend on the tax centers, and so countries are going to have a little bit different definition of those. But that's typically what we see, to which tax center are you reporting to? And then lines, 3 to 7 are going to have things that are actually on the tax return, one by one first, right? So we could have a reduced rate dummy here. That doesn't explain a whole lot, right? Top firms rarely get directly a reduced rate. That happens for smaller firms, actually. Then we have exempt income, right? So that explains a little bit. Special deductions, retiming. Sorry. Special deductions and retiming are not so important. The really important one is the tax credit one, right? The one we saw on the form at the end. And so, once you throw in everything, so all these controls, you've explained most of the difference. Note that there's still something that we can explain purely from the tax form or from characteristics. Okay, and so I think we're talking about that. Some of these things will literally be firm specific, and it's not something you can actually capture, which I think is interesting. Yes. Now, as I mentioned, in the end, how interesting is this? I would say not that interesting because it's not linked to deeper economic concept. That is, why are you giving those? What we would really like to know is, are you giving those away for labor incentives maybe, or more for R&D? It's very hard to do actually with the tax return, right? So this ends up being a little bit mechanical. Now, tax credits are often given for incentives for international relocation and the big firms, right? Yeah.
Sorry, I want to ask some clarification. What is from characteristics again?
Geography and sectors.
And what does tax credits consist of?
So, so they're going to vary across countries, but just going back, to that little form I showed you. So in the case of Rwanda, there were all these things, you see.
So my question is that it could be that the credit and the characteristic could be correlated.
Yes, you're right. So you would kind of want to see two, that you can put the two together independently. Then I think we had done that, but I don't have it here in the slides. You're right. So think of those, this is not necessarily a definitive answer. From the categories, tax credit is the most important. It accounts for over a third. But firm characteristics, also seem to account for quite a bit. And we're thinking, they're capturing in particular the special economic zones that at least historically were geographically concentrated. These days, not always, now you can have literally a firm part of a special zone that's by itself somewhere, right? Great. And so I think let's get to the meat. And here, I'm really happy to get a lot, any question you might have on, what could happen in the future. So first, a little bit of backpedaling on minimum taxation on corporation. This has actually a relatively long history. And if anything, poorer countries have been doing this for longer, right? And the way they've done this is often to try to have a wider tax base than the profit base, right? The problem of profit is that you can add all these deductions that become quite hard to verify potentially. And so while this is arguably the right economic object to have, it's actually very difficult to verify for the government, right? And so if you look at developing countries, to tackle evasion, there's been this kind of idea of having simpler tax bases or minimum tax bases. That is, if you don't report enough profits, well, then we're going to tax you directly maybe on your assets, for example. And there's a few, if you're interested in that, there's a few very interesting papers on this topic. Now, increasingly, though, countries are trying to go away from this, well, because, for example, a country could really have made losses in a given year, and it's not really fair to ask it to pay a lot of taxes on its assets, right? And they might not even have the liquidity to pay those taxes, right? So, as you get to narrower tax bases like net profits, the objectives become a little bit different, right? And so, what might you want to try to achieve with a minimum tax? The very basic thing you want to achieve is some limit on just pure profit. There is no real economic activity happening, but you're shifting across your subsidiaries, from the high tax country to the low tax countries, right? And that's been documented that it's happened a lot, and especially for the digital type firms have limited tangible assets and not only intangible assets. You could be a bit more ambitious and also say we want to set a real floor on what's acceptable tax competition. That is, countries can compete with low rates, but up to a point, right? They shouldn't totally eat all the tax base of their neighbors. And then the third objective, which I find interesting, especially given the figures I've shown you, which is you could try to equalize the within tax treatment of firms, right? And we've already seen one inequity within the system, which is large firms on average, which tend to be actually the international type firms, have an advantage as opposed to slightly smaller firms. Right? So that could be your objective. So let's do a very simple first simulation. Take the 1% largest firm in each country and just measure how many are currently paying under 15%. This is very simple statistics of the largest firm, what share are currently paying under 15%. And I think what's very interesting is actually this is relatively homogeneous, I would say, right? In a lot of countries, you have about 20 to 25% of the very largest firm currently paying a lower effective tax rate than 15%. This occurs, remember, in high tax countries. And actually, if anything, high tax countries don't seem very different, right? So Costa Rica has nominally a 30% effective tax rate, but 32% of its largest firms are paying an effective tax rate below 15%. So then you can say, you know, why don't we just simulate the simplest minimum tax rate I could think of is saying all the firms currently paying below 15% that belong to the top 1% should pay exactly 15%. This is what's happening to the right. And what the number I'm showing you is the revenue gains as the share of the existing corporate income tax, right? So what are your gains as the share of the total corporate income? Now, here the results become a lot more heterogeneous, and it's also because, you know, corporate tax data can be sort of skewed and concentrated. So, you know, let's take the Costa Rica example. My guess, because this is anonymized data, is that this is Intel. So Intel is a huge player in Costa Rica. You know, most of Intel's actually, even a lot of R&D, but a lot of HR and so on is in Costa Rica. It's probably paying 0%. So if you now make Intel paying 15%, you know, maybe not by itself, but, you know, you might have increased your corporate income tax by 50%. I don't know what will happen to Intel if it actually was taxed 50%, maybe it would leave, right? So that we don't know. But you see that, you know, in general, we're talking about not so trivial numbers, you know, with some heterogeneity, but, you know, a lot of countries, you know, the median country, I think there is Senegal, where it's about 23%. And so you had a question about Senegal. So you see the numbers in Senegal, the effective tax rate, I think, was very good because all the smaller firms were actually exactly a third, right? But in the top, it seems that it's actually not that great. So it's a country that's a bit different. They're giving basically no advantage to the smaller firms, while a lot of other countries are doing it. Right? Great. Okay, so we've talked about, you know, this is how what I call a broad-based minimum tax, because now I've really taken all the large firms in this, and we see that it could collect substantial revenue. There's some heterogeneity. And, you know, this is not just a hypothetical exercise. For example, Colombia is implementing exactly this right now, and I've read that Vietnam is considering this. Okay. And why are they doing that? I think now towards a more realistic analysis, because there is this plan of the OECD pillar, right? And so it's a reaction by these countries to the fact that they're going to be forced toward this regime. So let me tell you a bit more about this. Now, I want to do one caveat before is I'm not talking about behavioral responses. And I think one reason in this current context, they're likely to be very complex and depend on other countries' action, right? So we're reading kind of a game theory type of model where, you know, if all the other countries around you are also going to change the tax rate, well, then maybe that's fine, right? And Intel will not move, for example, right? So it's kind of hard in this moment where all countries are deciding a bit how they're going to react to know what to do. Because one thing we could do is say, why don't you just use the corporate income tax elasticities that we know, or semi-elasticities from tax differentials? You know, there's a literature about this. But I think those are not very well estimated because they're happening, you know, in this previous world, if you want, not the one where everyone is going to be changing the tax policy. Okay, so now let's move to what is actually currently being proposed. You know, that I think 2 or 3 years ago, some people called a revolution in corporate income taxation. Right, 100 billion global corporate tax revolution titled CFT, which since then I think the enthusiasm has a bit dwindled, and we're going to see partly why. Now, first, this proposal had 2 pillars. Pillar 1 is actually something that really has never been done. It was really an excess profit tax on about the 100 or 200 largest groups in the world. Right, so this was really a tax aimed for Apple and Google and so on. Initially, I think it was France and Italy who said we're going to have a digital sector tax on some of these largest firms. Then the US was like, that's really unfair. You know, L'Oreal is one of the most profitable firms in the world. Why wouldn't they pay also the excess profit tax? The US managed to make it wider. And so I think now, you know, most of the very largest group in the world are supposed to be bottom. Now, up to the latest news, it seemed that this would actually never happen in the end, right? So a lot of people say that the US, you know, played the clock, and basically now it's kind of scrapping it, saying that any case they could never pass anything through the Congress. So pillar 1 will not happen. Pillar 2, though, is currently happening, right? So I think that's why it's interesting. And pillar 2 is this minimum tax. Note they had quite different objectives, right? The first was an excess profit tax, saying groups that are extremely profitable should pay a little bit more. The other one is more like a floor on how little firms can pay, and it's also supposed to apply to many more firms, right? The first one was about 100 or 150 firms. This one would apply to, I think, about 7,000 firms.
But this is only for firms in OECD countries.
No, so let's come to that. So what's the pillar 2? It's a minimum tax in each jurisdiction where a multinational operates. Okay. Okay. And so the minimum tax we said is 15%. Who's eligible? Any multinational with over 750 million in global revenue. Right? So you're going to use the global revenue of the firm. If that firm is eligible, then only subsidiary in all the jurisdiction become part of the tax. Right? It's actually been relatively smartly designed. What do I mean? They thought about the incentive. What if a country refuses to levy a minimum tax? Well, then it's the headquarter country of the multinational that gets the right to collect that other tax. Yeah. It's actually quite interesting. It means that
there's no incentive.
It's kind of been proved basically so that there's no incentive to deviate, right? At least as long as there's enough headquarter country of multinational who are playing the game, right? Which really means if you have China, the US, and large European countries playing, you know, most other countries should follow suit. Yeah.
What defines a multinational?
I think just having at least operation in 2 countries, right? I think so, yeah.
Because the reason why I asked that is because a lot of Asian countries, for example, have state-owned companies that operate in many other countries. So it's also within their interest to collect the top-up tax as well.
Yeah.
Yeah. I get it.
And so to continue, they've even thought, what about if one headquarter country refuses to? There's even a mechanism for that, which is all countries, any other country can now collect the top-up tax in proportion to that multinational's domestic sales. Okay, so if France has 3% of all the Apple sales and the US ends up being out of the agreement, France can collect 3% of the top-up tax on Apple. Okay. So you can see, you know, the incentives have been well thought. And so now if you think about this group of low and middle income countries, if all these other larger countries are going to play the game, they might as well really collect their own top-up tax, right? And review all the tax incentives. And so I think that's why it's a really interesting moment, moderately for government in all these countries. At least they have to do something about all the tax incentive. Otherwise, you know, they're basically giving them for nothing, right? And so, you know, the OECD has come up with a name of what they suggest, you know, that countries do, and that's called qualified domestic top-up tax, right? Which is, you know, they even have a guideline of how countries could go about applying this.
Sorry. So in that proposal, is it possible for like countries to collect it, but then provide some compensation in terms of tax credits back to the companies?
So excellent question. So in theory, no, but now there's been a few loopholes open, and I'm going to tell you about those, right? Initially, no. Now, there was always this debate as could you keep the money back, direct subsidies, maybe on employment or things that are not part of the tax return? I'm not sure, you know, about what's the answer. I think it's not in the spirit of the reform, but of course, how would you go about monitoring this? Right? So what are the differences now between, you know, that kind of broader tax I discussed that would apply 15% to all the top 1% versus this OECD global minimum tax? First, I think obviously it only applies to large multinational subsidiaries, potentially introducing a new distortion between domestic versus foreign firms. There's a second one, but really it's not that important. It exempts very small groups within a country. That is, if within a country, a subsidiary does not make 10 million of sales, it's actually exempt. Okay, but 10 million of sales, well, probably depends on the size of the country, but it's not a very big threshold, right? Third, it applies the minimum tax at the group level and not at the entity level. And that can be important in some countries. You know, think Coca-Cola, typically they have production and distribution that can be 2 entities. In the data, we're going to see them as 2 different entities, 2 firms. You're supposed to consolidate that before applying the effective tax rate, right? So that's going to bring some data challenge. And now we come to, I think, the 2 big loopholes, if you want. Now, 4, the OECD will not call this loophole. They're going to provide what they call carve-outs, meaning deductions for payroll and tangible assets. So if you actually have real economic activity in the country, you're going to be able to deduct some of that from the top-up tax shield, right? So thinking back of the spirit, remember, you know, why would you want a minimum tax? When one reason could be to cut profit shifting. Okay, so that still should be successful with this reform. Limiting tax competition, well, they're saying not so much, at least, right? And so I'll show you those carve-outs start quite generously. It's about 10% of the value of tangible asset and 10% of payroll.
So I'll show you an example. For some firms, it's really going to wipe out all the top-up tax. It is going to decrease a bit over time and reach 5% in 10 years. Okay? So it's kind of a way to soften a little bit and introduce it a little bit in a softer way. Probably even more importantly, now we're working on that. I'm not going to show you a lot about this today. With the Biden plan for renewable energy and climate change, the US pushed for the fact that green environmental tax credits will not be counted as part of the effective tax credit, right? What's the issue with that? Is first, a lot of other countries said great, so I think the EU and China were happy to jump on that. But the big problem is how you're going to classify those tax credits. And I think that's going to become really a big problem. It's very likely to have a greenwash within the minimum tax, right? Now, this is very hard to measure currently, right? I mean, we're trying in a few countries, but this is probably where the big loophole is going to come. So compared to the other tax, I think it's really important. In the spirit of this tax, there's no really an objective to limit tax competition. You're saying as long as it's kind of fair, planned and you're constructing actual activity in a country, we're not really trying to limit it. If anything, if you're competing on green investment, go for it. We all know, right? That's a bit the message. Now, let's go a little bit to the data and to think, how is the country supposed to observe, especially 1 and 2, that is, which firms are subsidiaries of big multinationals. And so here, the OECD has thought of something which they've implemented now for a few years called the country-by-country reporting, CBCR. Right? And so all the very large multinationals have to send to their respective countries the country-by-country revenue, employment, profit, and taxes paid. Okay. The OECD never actually gets, I think, the micro data, but only some aggregates at the country pair, right? So it sees US to Mexico, number of multinationals, total revenue of those multinationals, total profit. But in theory, Mexico could request from the US to get the micro data, right? It's a fully decentralized system, which means that the governments should talk to, that have been relatively smaller countries, have not currently used this data, and it's not clear they have it, right? So that's the first thing for the implementation. So we're not going to use this data because they're not using it. What we've done with a few governments is start working with the Orbis data as the best approximation of which firms are subsidiaries of big multinationals. So let me tell you a little bit about Orbis. Some of you might know this data already. So Orbis, in the countries where we're looking at, is actually extremely poor. So what do I mean by that? Look at column 6, the share of firms with turnover revenue data in these columns. It's, it's often 0, right? Now, and you have to really watch out because in some countries there are numbers, and then if you look, it says kind of it's imputed data. Maybe because, for example, they have the number of employees, and from that they kind of make a calculation to revenue, right? But it's totally mechanical and not particularly interesting for our purpose. Okay. Greece is the only country where you have a little bit of data, right? And so indeed, when you go to the richer countries in Europe, you get a bit of data. But Orbis shines somewhere, which is very useful for us, which is about the network of firms, right? Because the big multinationals located in China, the US, and Europe are actually reporting relatively well their ownership, they are reporting about the subsidiaries. And so there's one comparison we can do, for example, which is, I think, the right comparison would be 8. No, it would be 8 and 10, I think. This is that CBCR data I told you, this aggregate data that's reported to countries and that then the OECD aggregates on how many subsidiary groups, right, are supposed to operate in the country. And this is what we estimate from Orbis. Okay, so you see, if you compare 8 to 10, it's usually pretty close, right? Now, there can be some little errors, for example, because, we're using the filter in a given year, and maybe it's actually not exactly the same year or so on, or maybe, sometimes Orbis is missing a little bit of data. But overall, I would say, this is pretty good. So it gives us some confidence that using Orbis at least to identify the subsidiaries of big multinationals operating in these countries is useful. So I'm going to show you one application of something now we're doing a little bit more systematically, which is what we can do, for example, in Honduras. So Honduras is one of these countries where the broad minimum tax I told you about, that is taxing at 15% all the top 1% firm, would have actually raised quite a lot of the corporate income tax, right? More than a third. And let's compare to what we think would happen under the Pillar 2 of the OECD's global minimum tax. So first, it's only going to apply to subsidiaries of the large multinationals. So this means that now we left, in the top, we left with 237 in-scope entities, subsidiaries, which correspond to 126 groups. Okay, but now we've reduced, it's not all the firms, it's only those 126 groups. First, what was our match rate from Orbis to the Honduras data with names? It was 78%. So not perfect, right? We lost also some firms in the match rate when we took the Orbis names. And what we actually didn't do, they did it at the Ministry of Finance, and they sent us back the anonymized data. Of which we find that 106 are active, meaning they filed the tax return in the year we were looking at. Okay? Then remember, step 2, we're going to exempt the subsidiaries that don't have enough activity in the company. They need to have at least 10 million in revenue, right? So we left now with about 71 consolidated groups that are considered in scope. Sorry, that wasn't needed. Of which, so we have 71 groups. 19 of the 71 groups are paying an effective tax rate below 15%, and so they're in scope to have a top-up tax. For those now, remember there's one more step. They're allowed to deduct their true payroll and their true tangible assets. So this is the distribution for those, we only have 19 firms left. What happens, what's the carve out over the net profit? So you see that for 7, and I think, what do we have 2 groups? Oh, no, yeah, for 7 firms here, forget this legend, I think it doesn't mean anything. Well, for really 8 firms, this is about 100%, right? For half of this firm, this deduction is going to wipe out all the top-up tax. And then you have for some firms that it does not. So maybe those were the firms that were, had very little real activity. Those were the tax avoiders. For those, you would actually have it, right? But you see, for how many firms does it mean it really is going to have an impact? In Honduras, it seems about 8 firms on my calculation, right? So what does it mean? So we had 19 firms, 19 groups were paying less than 15%. Now, another important parameter is what was the mean effective tax rate of those 19? I think that's something very interesting. The mean effective tax rate was 0.3%. So this one will literally paying nothing, right? Meaning that the top-up rate is going to be non-trivial. It's going to be 14.7, to which in this case we have applied the carve-out. So you see, with that carve-out, we estimate that the corporate income tax will have been raised by 8.6%, with carve-out by 5.5%. Remember, we're comparing this to the 37%, right? So this has decreased quite a lot once we're now in the realm of the actually applied minimum tax. And this is before even thinking of the green tax credits, which might be added, right? So you can see kind of the big difference. That's method 1. And we wanted kind of a robustness method because in Orbis, we're arguably missing maybe a little bit of activity and of firms. The other thing is actually Honduras has an indicator of what firm is a multinational or not. But what firm is a subsidiary of a multinational. That doesn't mean necessarily that they would be in scope, right? Because we don't know the total size of the group to which they belong. But we could just say, from the multinationals, take the largest ones. How many? Well, just as many as they are in that CBCR country by country reporting data, right? The country by country reporting data says there's 216 firms, subsidiaries operating in Honduras. Let's take the largest 216 subsidiaries in Honduras, right? If we do this and repeat exactly the same exercise, then we would get 13.9% increase in the corporate income tax, and then 9% after the carve-outs, right? So think now, let's say, this looks a bit more like an upper bound number, right? Because we've taken the largest subsidiaries. Maybe some of those are not in scope, right? Because the group is not large enough. So that gives us, I think, a relatively reasonable bound. Without carve-outs, 9 to 14%, about half, a little bit less than half than the first number I showed you. With carve-outs, 6 to 9%, right? About a third of the kind of broad minimum tax. Okay. So, that's something we're now replicating in other countries. As you can see, it's quite involved because it requires the tax administration or the Ministry of Finance to merge the Orbis data, right? But to be fair, about half the countries are willing to do this and are currently doing this. It requires that merge to not be too bad, but actually typically we're getting about 80% merge rates. So I'm going to have so the Honduras data, we've already replicated it for Greece and South Africa, and it looks very similar. That is, you end up after the carve-outs with about a third of the revenue of broad minimum tax. So what we've documented here is that you have this inverse U-shaped pattern relation between effective tax rate and front size that I think is interesting for several factors, including those of you maybe working on entrepreneurship and so on, right? It tells you something about who is advantaged by the tax system more generally. But then we think, at least for our interest, the really critical fact is that those very large firms are benefiting a lot from the tax system and more than other slightly smaller but still large firms. Tax credits, is really the single most used instrument to lower the effective tax rate of those very large firms. And we're giving some idea of the fiscal cost of those tax incentives and what would happen under a minimum tax. So I think, in a way, this opens more questions than it solves. One is why are tax incentives highest for the largest firm? Presumably to attract investment, but is that a good policy, right? And what does that mean then for the kind of dynamics of firm growth in these countries, which I think some of you working maybe in more dynamic macros, I think it's a really interesting question. And to what extent, a lot of these incentives not given to infra-marginal firms who would be there in any case. And my sense is probably quite a lot. But that I don't have a great answer. And I think the second thing where really I'm hoping to work more is how will this global minimum tax shape firm and country response? It seems from what we know that is going to occur under some kind of partial implementation of the global minimum tax. That is only some countries have committed to implementing it so far, with a big caveat that it's not clear what the US will do, right? So in a world where Europe will do it for sure, they're already kind of in process.
So even in Luxembourg and everyone is implemented?
Yeah, so that, there's an EU directive that forces the member states to do it, right? So this is happening. And I was reading the other day, they sent some rebutometry, not to Luxembourg, but to Hungary, which often these days is the country that's not playing by the EU rules. Now, I don't know what will happen if they keep on not implementing it, but that's the idea. And what's interesting is already some middle-income countries are reacting. So I told you Colombia has already passed a law to have its own minimum tax. I was reading that in Vietnam, there's actually a legal plan that's ready. I don't know if they're waiting to see what other countries will do. What's for sure is that countries are going to, even if just Europe does it, it's going to force at least some reckoning about what are our tax incentives, right? And think about them. And think, are they compatible with at least a partial implementation of the global minimum tax? And, sorry, go ahead. Yeah.
I just want to wrap my head around this. So for instance, but let's say what we think about is, say, traditional tax havens. Are they going to be, so for instance, the Cayman Islands, are these countries in any way likely to also?
So not, so Bahamas introduced for the first time a corporate income tax, right, not that long ago. It's still very low. I don't even think it's 15, which is interesting because they clearly, a lot of places are trying to be a bit in this in between, and I think see what's going to happen too. If they don't react fast enough, that the risk they actually start losing a lot of tax base, which really means they're giving tax incentives for free, right? Which is quite risky if you think of their public finance of a small states.
Because of the stopping up policy, I mean to say.
They know at least that France and Germany is going to apply at the very least.
Okay.
The low tax jurisdictions still have incentive to remain as low tax jurisdictions because under the QEAPCE, there are two. So for example, let me give you a concrete example so that you understand. So Malaysia has 24% tax rate, right? So if this low tax jurisdiction implements a CIT of like 9%, there's no way Malaysia 4%. So they get all the shifting, and then the 15% top up rate. So they will get the first dibs at the 15% effective tax rate. So low tax jurisdictions can still win from this.
Should they get the 50%, but that means the tax firm effectively gets 50%.
Yeah, so they get and still compete with the tax rate, and you can't do anything about it.
If you're above the floor rate, basically, you're saying.
But I think that's a good question. Is the Bahamas and the Cayman Islands the initial place to invest if effectively it becomes 15%? Right? I don't, you could imagine that there's other transparency or reasons to be there, right? But that I think is going to happen, right? The interesting part is I think what's happening to all the countries a bit in the middle that are not presenting themselves as low tax countries, but as we discussed, I think for the case from Malaysia, they do have to think because these reforms are impacting them, right, indirectly, at least. And so it's possible that one of the responses would be a big reclassification of a lot of tax incentives into green tax credits or other subsidies that are even totally outside the scope of the corporate income. So I'll stop here. Yeah, this question.
Is there any evidence as to like how much the missing tax is due to tax evasion versus, let's say, lobbying or tax credits?
So how big is tax evasion as a problem relative to tax incentives?
Yeah, like for example, like Amazon's like negotiating with like states to get like tax breaks and whatnot. How much of, I guess, their effort should be on lobbying the government to get the preferential tax credits versus just evading tax completely?
No, it's a good question. So let me try to think of the magnitude. So there are, this paper that's global love shifting. So I think tax evasion is probably more avoidance strategy kind of. Yeah, and so let me try to think what's the most comparable number, but I think it's found often that between 5 and 8% maybe of the corporate income tax is avoided. Right? Globally, of course, this is probably more pronounced for some of the larger firms, with the intentionals and so on. You see here that the effective tax rate we find, well, that's a much bigger drop, right? So I think the tax incentives is a bigger problem in general. Now, it might not solve the problem because you think they hit for good reason. That's a big deal, right? So, the profit shifting gap, I think it's going to be close. There might be some new ways that if you want, you're going to gain 5 to 7% more revenue. The question is, can you get anything else kind of limit also a little bit tax competition, which when it's too aggressive, it's arguably a zero-sum game, right? So, yes, sorry. Yeah.
Question. From your first report, in budget relationship between effective tax rate and firm size, is it possible to detect the threshold from the data, the threshold level of the tax rate?
The threshold of the tax rate.
Effective tax rate, the threshold, is in budget shape.
So where does it fall? You say the distribution? Yes,
From the data.
yes, you can see it from the figures. Maybe sorry, it's one again. This is good. Yeah. It varies a little bit by the country, but it's actually relatively stable. It's around the 85th to 90th percentile typically. Where is it here? Right. It's going to depend a little bit on the country, but you see it's often somewhere here, right? The kind of inflection point. So right now, this could be different revenue sizes depending on the country. What I find quite interesting, that would be another way you could show the data, show absolute size of firms, right? That would be now more comparable across countries. But we think a lot of this, when you're comparing, is really interesting within country. No matter the absolute size of firms, countries are often advantaging the relatively larger ones within a country. Right? So.
One more question. When I look, you show the different sizes of the firms in each country. So I noticed that there are some countries with a lot of farm level data, while some have quite low level data. How did you treat this impact in your region?
So some countries you're saying there's relatively few firms in the data. Yes, that's a very good point. And that's very correlated to population obviously, but then income level, right? We're not, in what I'm showing you, we're not doing anything about this, right? So you're right, in Senegal, it's only a few thousand firms, right? And so what that means is there's really a huge tail of firms here, right? That, matter for some question. We think that for the fiscal cost, they don't matter so much in any case because taxes and profits are so concentrated at the top in any case, right? So I think for the question we're asking here, it's probably okay. But we should probably try to show you some numbers on what are we missing here. For other questions about firm dynamics, for example, I think it'd be key in these countries to add, both the informal sector and the kind of small scale sector that might register, but not for the corporate tax.
Can I ask one more?
Yeah. I think there was another question here. So why don't we take one and then?
Okay, my question is a bit different. I do a lot of research on R&D. Would you be able to get ideas about tax incentives from R&D from some of these data for some countries?
Yes. So again, with the caveat that sometimes it's neatly marked, if you want,
Okay,
because the law was specifically about R&D, and other times it's kind of the law was aimed for many things at once, of which one is R&D, right? And you might not know if it's for R&D or for employment, for example. So that's, I think, the little limitation. And so how would you go about this? Some countries have extra appendices, basically, of the corporate income tax, which might detail that, right? We haven't systematically asked those, and it's not clear in what state those are.
A completely different tap. I was just wondering, given that you are in this literature, no, that have there been no kind of initiatives to think about how administratively, I mean to say, when you think about how tax reporting is done, that, you know, I hire the firm, I pay the firm, and then the firm says, Rajesh, you are very clean. Nobody's put up a proposal saying, we have a centrally funded auditing system, right, where you don't tell me, you don't pay me the money, and I come and say, hey, Pierre, you have your books in a great shape. But the government says, all firms put in centrally, you're going to randomly hire auditors, and we are going to pay the auditors. And that should take away so much of all the strategies that firms have in being able to use these techniques, right? Because at the end of the day, it's like, I don't know if you know this, Mr. Ferry's work also, he shows that people who are very rich also have extremely high returns. It's also because of the kind of loopholes, strategies that they're able to afford, right? And which goes the same for your top 1% firms. You said, where are they placed? Could be one thing, but are they placed in areas where they're able to exert influence through whatever variety of ways they can make these benefits for themselves?
I like your idea of the label a lot, you know, some kind of label. Now, this is, some people are pushing it via the corporate social responsibilities, right? And so there's some people who think, well, there should be a lot more about taxes and good tax practices. But now, how much are those actually being followed, right? I think that's a different question.
Yeah.
But there is a movement within investors to try to have more stuff about good tax behavior within the...
But these are again kind of non-incentive compatible kind of mechanisms, right? And that one I was suggesting would be, I take away your incentive. You don't have the right choice to be able to do this negotiation with your auditor to come up with a good-looking solution, right? And it's kind of blind assignment in some sense.
I kind of like it. Then, of course, there's a question of who's auditing the auditors, which is right.
Yeah.
But yeah, it seems like a good idea.
I just wanted to ask your opinion on the OECD, this thing, because it's their second attempt at a global tax system, right? After the 15 pillar BEPS measure. But there is a new player in town, like the UN has taken credit with the tax convention that was brought forward by the Africa and Food. So how does that interplay with this? Because the UN is, covers much more countries than OECD.
That's a really good question. So first, okay, second attempt is a little bit unfair to that because BEPS, put a lot of the things in place that's needed even to think of that. The research one is the CTCR, right? Yes, something that would like to be part of BEPS. So, I would think of this as a bit more of a continuum, but that's the first real ambitious proposal, right? BEPS was not that ambitious, but at least put some of the monitoring and some of the measurement in mind, right? To the UN, so I don't know if all of you have followed, but the African group indeed saying, we don't, so we are sitting at the OECD for these conventions, we really don't get a say, and so that's unfair, which seems democratically correct. Now, if you want my take, it's also a way to delay a lot the process, right? Because it's been so long to get to there that if you restart from close to zero at the UN with even more participants, I think we're delaying another 10 years having anything, right? So I think the good solution is probably you go ahead with Pillar 2, and then you think of what's the way to manage this going forward that's more democratic, right? And so I hope that's what they will do. And that's why, I don't know if you saw it, the UN, all the European countries voted against, and I think with that logic, not that it was very necessarily against, having the UN as the supranational director of this, but because they thought it would be, delaying the process. So I don't know how that's going to play out. And we're actually marching conference just about this topic to know what should be the governance going forward. And right now, I think that's one of the problems. The OECD is a very toothless organization, right? It's not, I mean, it's really a club of rich countries. It doesn't really have a real mandate. I mean, the mandate comes from the G20.
We got questions?
Yeah, we have an online question specific to Malaysia. One, Seattle from Ministry of Finance. You mind unmuting?
Hi, I have a question. For Malaysia, who already given tax incentive, given tax
Sorry, you need to speak up.
Hello, can you hear me?
Yes.
For Malaysia, a country who can be a bit generous on the tax incentive purpose to encourage businesses, how to limit the profit shifting and provide a balanced view in line with GMT in terms of policy, and can you share maybe other country strategy? Thank you.
So I think, let me try to rephrase to see if I understood well. Is how will the global minimum tax affect tax avoidance in Malaysia? Is that right?
The question is on profit shifting. You are talking about profit shifting and to provide a balanced view in line of the global minimum tax.
Yes. Okay. No, interesting. So, look, I don't have the numbers. I wonder how many studies have some. I will look for some country by country numbers. So Malaysia is kind of not such a high tax country to begin with, especially given that it has quite a few tax incentives. So I'm not sure, it's going to be a country that gains a lot from the minimum tax. The simulations that have been is typically the biggest gains are actually in the US, in France, and Germany, typically. And if you look on net, it's kind of middle-income countries, they're pretty neutral with this whole profit shifting change, right? Meaning that they don't lose, neither do they gain a lot. So that would be my take. I don't have the Malaysia-specific numbers though in mind.
Thank you. Thank you.
Daniel?
So would the global minimum tax has implications in terms of whether countries with lower capacity to enforce taxes or collect taxes, would that have implications on the disproportionate benefits of the global income tax for different countries of different capacities?
I think for sure, that's a really good point, which is we've seen it's not that easy, right? It might need the PCR data currently is not really shared. So it's very possible that we get into some legal problem where, Germany say, I'm doing the top tax there, but then they say, no, we were planning on doing this, and I don't know what's the conflict resolution mechanism. Again, about the governance, and going back to that, I think the OECD has some guidelines for, they call them safe harbor rules and ways to kind of deal with this type of conflict. In practice, I wouldn't be surprised there's lots of them. And then, as you say, who's probably going to lose to this conflict is likely to be the countries with lower capacity, right? So I think, that's a very interesting point. Now, to be fair, there's a few things that have been thought in this line, including, for example, I was saying that India is actually quite excited about signing the Pillar 2 because within the Pillar 2, there's things about royalties and so on. So there are some things that have been thought, if you want, within the law to kind of simplify, but it's still a relatively complex system, right? And so, one of the things about the Pillar 1 that people hated, the other thing, is that measuring excess profit tax, well, it's a very fraught exercise to begin with. What is excess profit, right? And so they could, they had a really hard time coming to the agreement. And if you look at the OECD paper, it's so complex that I think most of us, when we read it, at least the first few times, we don't understand what's going on. So how are you expecting, a lot of countries to implement that, right? So I think that's one of the issues, right?
Question on the 750 million threshold. Where does it come from? And, why 750 plans to, move that up or down? And whether that creates incentives for certain firms to, stay below that threshold.
Yeah, we looked at this and actually, I don't know how they decided it, but it's not that important because, again, it's so concentrated, right? So even, 750 million threshold means you still have 7,000 multinationals, but really the top 50, or the top 100 are so important that, getting to 7,000 or 8,000 multinationals is not very, at least on aggregate. Right now, for some countries, for more regional multinational, that could
But
matter.
you're gonna apply the 15% tax rate to the entire profit, right? Like,
Yes.
so it creates incentives for those firms that are not so important.
Yeah.
Potentially stay below 750 million threshold.
You're right.
Yeah. Forever. So which
You're
would
right.
have directly impact.
Yeah, and I don't know how it was thought about it. Yeah.
The proxy of size. If the proxy of size, is it revenue or total?
It's revenue. Yeah, USD proposal is revenue.
In USD or in currency?
In euros, actually. Probably because the USD is in pounds, but it's in euros. So. That's rare. But it's euros, yes.
Should be.
Yeah.
So we're already over an hour, and I'm gonna finish the seminar here. Thanks a lot, Pierre, for such an interesting talk. And I mean, we can still talk. If you have questions, we can talk outside. We have coffee. So feel free just to ask Pierre whatever you want. And thank you all the people that connect online. And happy Chinese New Year. I'll see you in 2 weeks. Next, not this Tuesday, the next one. We have seminar again. So thanks a lot.